Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm Lance Pederson, host of Real Estate Risk Report. So today I have with me Scott Rerucha with Legacy Group Capital. How you doing, Scott?
Oh, I'm doing great, Lance. Thanks for having me on.
Yeah, my pleasure. So a bit of backstory. So I've known Scott and the group at Legacy for quite a few years now. They've been a longtime client of ours. Really great guys. They're based up in Seattle, and I'll have Scott sort of share a bit about his background and where Legacy comes here in a minute. But today I think we're going to be hitting on sort of Scott has a lot to offer, so we'll probably have him on a couple times here to cover all the material. But I think that in particular, we're going to talk about a market in Seattle that has some very interesting, sort of supply and demand things going on up there that make, real estate investing, very interesting. And I think, that Scott can kind of get into, and in particular too, just what those supply and demand metrics around housing and things, the opportunities that it creates, and how the folks at Legacy sort of are able to create value out of that opportunity. So we'll get into all of those things and obviously spend plenty of time talking about risk. But why don't you sort of give us a little bit of background, Scott, on sort of how you got into the business and what Legacy Group Capital is doing?
Sure. No, thanks. Yeah, well, I guess I'll start out. I'm born and raised in Seattle, Washington, and so are both my two main business partners here, Brent Ely, who actually manages our fund day to day, and another gentleman, Chris Gurgeon, who heads up our real estate acquisition division. And so, we're all Seattle natives and know the market very, very well. I grew up here, graduated from Seattle University in business, and then went into banking originally and got into lending right away, both commercial lending and mortgage lending. And so I spent a number of years doing that, learning the banking side of things. And then I was most attracted to the mortgage lending side of things and residential lending. So I actually went off into that, and I actually started my own company. It was called Bay Mortgage, and it grew over about 4 to 5 years to be one of the largest mortgage brokerage operations in the state of Washington. So got a lot of experience in mortgage lending and mortgage banking back then, and ultimately sold that company to a bank and went to work for the bank running the entire company, and had a stint there. And then after that, I joined a group of guys locally here, a couple guys that were starting a de novo bank. And the goal was to start a small commercial lending private banking entity that would have also mortgage banking operations within it. And so we started that bank, and it was called Enterprise Bank. We had that for 5 years, and the bank was very successful, one of the most profitable startups in the state of Washington ever. We had a great 5-year run. Unfortunately, Washington Mutual came in at year number 5 and bought us out lock, stock, and barrel and took the bank over, and ended up to be a good business transaction. But during that period, I really learned how to grow and build a banking organization. And now I was learning more just than mortgage lending, but commercial lending and in all facets. So that was a great piece of knowledge to gain during that time. Then after that, I went out after the bank was sold, and I wanted to restart my own company again. I started Legacy Group, and it started out to be a mortgage banking operation. And I built that up to be, I think, in the top 25 in the country for mortgage bankers. And, we were doing $3 billion a year and competing with the big national guys. And we had 28 offices, and we were lending in about 6 or 7 different states at that time. And so while we built up that mortgage operation, and by the way, both of my original partners have been with me through this whole thing. So we've been together 20 years plus type of thing, working together. And so in different facets of the business. But we built that operation. And during that big mortgage banking operation that we were building, we decided to open a private lending company that we named Legacy Group Capital. And that would be an entity that would lend to builders and real estate investors on kind of non-conventional type of lending stuff that we could go out, we would raise some capital, we would turn around and lend that capital out. And that's how Legacy Group Capital was actually born. Because when you have a mortgage banking operation, Lance, and you're doing, 600, 700 deals a month, you're going to have some loans that don't go through that are probably pretty good deals. And so we would one-off hand pick those deals, and we would put them into our private lending side. And, somebody was willing to pay a higher rate, to get their deal done. And so we would privately fund some of those deals. And then we also started funding to small local builders too on some construction stuff. So these were running kind of parallel side by side, these two businesses.
Yeah.
And in 2013, we ended up selling the mortgage company off. The rules had all changed. Regulations were getting strict. The mortgage company was doing very well at the time, but we decided to sell that company off. But what we did is when we sold that company off to a large national player, we decided to keep the private lending company because we were really attracted to that whole business model, and we wanted to grow out that piece. So we came into this private lending thing that we had started, the Legacy Group Capital started in 2006. And, our background really that we brought to the table was nobody knew much more about lending than we did. We knew lending from all facets. And so we were going to turn this private lending company and create a couple of real estate funds that we would lend out of on real estate deals. And so we created that. And our other expertise was in real estate development, because the group of us over the years, we'd also been doing small residential real estate development deals. And so we'd been doing that for about 20 years. And we had been inviting investors along with us while we were building these other entities. So we were experienced in lending, we were experienced in real estate development, and we knew the Seattle market like nobody else did. Yeah. And so that's where we kind of launched this platform from. And, then from that, I guess maybe the next step would be to jump into kind of our platform and maybe what it looks like today.
Yeah. I mean, I think that's it. So sort of just extrapolate on how you brought that into, obviously it's, how you guys kind of take advantage of those. And I mean, ultimately it allows, the passive investor to sort of participate in what you guys have.
Yeah. So I think our platform is really unique. There's nobody else in the state of Washington I know that has a platform like ours. And, Lance, I know you've been with us a long time, so you've seen the success over time. It's, when I tell people that we started our first fund in 2006, and then we went through 2007, 2008, 2009. Yeah. We didn't have one investor loss, and we hadn't foreclosed on one property during all that time. And our returns back then were in the 12% range, all the way through. People say, well, how could you really actually do that during that time? And it really all comes back to our platform and how we set up that I'll explain to you right now. But what we really do at Legacy is we have a couple different divisions. One is we have our lending division. And out of the lending side, we have two different real estate funds that we've set up. And, folks invest into the real estate fund. And then one of the things we do out of those real estate funds is we turn around and we lend money. And we lend money in three facets. We do construction loans. So that's a ground up construction. We do rehab loans to those guys that do fix and flip type of properties. And then we do bridge financing for more real estate acquisition. And, our longest loan is 2 years. Our average loan turns in about 9 months. And so we have this very quick turning portfolio. And one of the things, that I'm always asked is, how do you, mitigate risk in what you do? And one of the pieces, how we mitigate risk is our portfolio by design, turns in 9 months. The shorter turn time you have on a loan, the less that can go wrong with it. Yeah. And so, between our product base, we're turning these deals average in 9 months, which is, makes our portfolio a little bit less risky. So we lend out of our funds, and we do that short-term financing out of the funds on those three type of loans. And then that's one piece of what we do. The other piece is we have a real estate acquisition and development department. And that's my other partner, Chris Gurgen, who's been a successful real estate developer for the last 15 years and has probably developed over 1,000 properties in the Seattle area, all residential, small residential. Our target market is 1 to 10 unit residential projects. So, an average deal for us would be like that we would lend on or develop ourselves would be like a 5-unit townhome site in downtown Seattle. we stay mostly within the core of Seattle with everything we do. And all of our lending, again, is in the greater Seattle area. We stick kind of to the market that we really know. But we have this real estate acquisition and development department. And really what they do is they're a handful of experts that have come into our company. Chris brought his group in and bought in as a partner a number of years ago. And what they do is they source real estate deals. And they are connected to probably 50 of the top agents in the Seattle area that will bring them off-market deals. And then what we do is we get a deal in, and the first thing that we do is we break the deal down. We run feasibility study on a deal. So it could be a piece of land that, let's say it's going to be a 5-unit townhome site. We'll source that deal. We'll run feasibility on it. We'll even, develop a plat design for it. And our guys that work in that department are permitting experts. A couple of them have worked for the city for years that we've hired that, used to approve all the permits. And now they're working for us. And so they know the city code better than anyone. So we come in, we do due diligence on this stuff, and we underwrite it. We draft up a pro forma. We draft up a budget, a cost breakdown of what you can do. And then what we do is we turn around with that project and we'll take it to one of our 50 local builders who borrow from us consistently, and we'll deliver a project to them. And they'll pay us an assignment fee for delivering the project, and then we'll turn around and we'll lend on that project to them too. And so this is one piece of the platform that we have. So we're not just a lender, but we're bringing in real estate deals as well, and we're providing those to builders. And it's a little different scenario when you're doing that, because instead of builders always just walking in with their own deals and you're worried about, does this deal really pencil and does it underwrite? And how long will it take to get this thing permitted? Our department, our real estate acquisition team, not only do they deliver these deals to builders, they take them all the way through permitting for them. We handle the permitting process for them so that they can be out working on their other deal while this one's getting permitted and getting ready to go. And that's all part of the fee that they paid. So we have this lending piece. And then on top of it, we have this real estate acquisition piece that really dovetails nicely with it. And as you can imagine, we're pretty popular with the builders because they're always looking for deals. So that's just a really, again, without getting into the funds and how they work, that's kind of an overall of kind of how we look.
Yeah, no, and that's helpful. I mean, I think we can, and all the things that you can hit on. I mean, I think, as you said, is so as lenders, you want to borrow money to a builder, but in this case, the risk mitigation tactic is sort of, you're already doing the feasibility. You've got the front end. So you're like, we feel good about this. Now you're sort of reducing execution risk.
Yes.
And obviously you're intimate with the project. So there's no, it's not like they bring it to you and then you're trying to, they painted some picture of how great this is going to be. And, we're going to do all these wonderful things. And then it turns out that, their plan wasn't so wonderful after all.
Exactly. And because of the team that we have and because of their expertise, and trust me, if there is a zoning question for Seattle, if if somebody comes up with a property and they deliver it to us, we're going to be able to tell them a lot better what they can do with it than they would ever know. So we have builders that come in all the time and say, hey, I got this great site, I'm going to build 6 townhomes on it and I'm going to do this. And our group will take a look at it and they'll go, you're not going to get 6 townhomes on there. That's not going to happen. And here's why. And, a bank just doesn't have the ability to underwrite a deal like that. And so that's, again, another piece that, whether, again, we source a deal or people are bringing it to us. And, the fix and flip market's the same way. I mean, we want people come in here all the time wanting to do fix and flips and they want to get rich doing real estate. And, half the deals that we look at when we underwrite them, we go, these deals, you're not going to make any money on them because, the margins are very tight. And so, again, we have the ability, because of the expertise, to really underwrite things that way. And
it makes sense. And it is, like you said, it is unique that you do that, but that is a huge piece of mitigating the risk with this sort of thing. One, the things we hit on is knowing your market. So, and then having resources on board that really know the viability of things. Right. And so, if someone shows up, at the same time, you're adding value to, like you said, those builders and the rehabbers, because a lot of times that's just it. Like they getting that insight, that's valuable to them. And it goes beyond, because money's fungible. Let's face it. At the end of the day, right. There's, you've got obviously the institutional, banks or whatever, but there's a bunch of other guys who are lending private money in Seattle as well. And so, but if I'm a builder,
yep,
right, or I'm a rehabber, and I can go in, that can mitigate my risk by having access to where my lender knows better than I do on the viability of the project. And so that way, because there are obviously guys out there that are just reckless and are just they just go buy stuff and that's the terrifying end of it. But most of them are responsible, and they end up it's their own ignorance that gets them in trouble when they get into projects that they can't execute on. And then if the lender, he's an out of town lender or whatever, they're borrowing money, that's how these things go sideways.
Absolutely. I think one of the things too is that when I really look at, again, being from the banking industry as well, and I've run a construction loan portfolio for a bank too. And I can tell you, the bank's ability to underwrite deals and track deals and really know what's going on. I mean, banks really take a look at a deal and they go, is the property good? Do I think this builder's a good guy? And does he have enough money in the bank? And that's how they make their decision to lend.
Yeah.
We're way more control freaks than that. We didn't get through 2007, 2008 without any losses, without having some additional controls. So to give you an example, one would be, so when we assign projects out, we require that the builder does their bookkeeping on that project through us. So we will actually handle their books, not, we don't do their accounting for them on, as their business, but we'll handle the books for that project that we're lending on. And the reason we do that is because, we have about 50 builders in our stable that we lend to a lot of them over and over again because we know them really well. And, they're doing projects. And so we want to know where they're at on that project. If there's another project that they want to step into that's going to be 3 months down the road for permitting, are these guys ready to go? Are they going to be selling out of this one to get into this one? Are they over budget on this one? So they pay us a fee. And right now, Lance, I think we're running about 70 sets of books here for different builders on projects that we're lending on. And when you have that kind of control, when you brought the deal to the table and you underwrote the deal, and then you're doing the accounting on the deal, if the deal starts to go sideways or that something's going wrong with the builder, or he's got another project that he's all tied up on, we know it before anybody else knows it because we see the numbers. And then if we have a problem, we can get in there and correct it. Banks don't have the ability to do that. And so what happened in 2007, 2008, sure, we had a few projects and builders that were going under. And what we did is we met with the builders and we said, here's what we're going to do. We develop real estate too. We'll take over the project. We're going to go finish your project for you. And then we're going to sell it out. And that's what we did. And they would turn them over to us. And we probably in 2008, I think we took over 3 projects, of which we finished those out and sold them out. One of them, we might have lost a little bit of money on. The other 2, we actually made money on. But if you're in a bank environment, what the bank will do is they'll foreclose on the property. It'll sit there for a year and a half. They'll board up the windows, and then they'll try to fire sale it 2 years later. And everybody's lost a ton of money. As opposed to us finishing it out in 3 months and selling it and moving on. And we're, small enough and nimble enough to do that. And so, because we're developers as well as lenders, we have the ability to do that.
Yeah, no. And I think that's that vertical integration that is so, it's so important. I mean, and that's the issue, right? Is that it requires experience to where vertical integration can work. Meaning you can't just roll out of bed and say, I'm gonna get into real estate and then just build a completely vertically integrated, business. Right. I mean, we're no different, at Verivest of my day job when I'm not, doing this podcast. I mean, it's the same thing. I mean, like what we do is super complicated, but it takes years to build it where everything's sort of integrated with it to truly create that ultimate value to the end user. And that's like with what you guys do is that, frankly, it's the same thing. I mean, that's the similarity between us. Like our clients don't want to be doing books, right? They want to be working on real estate. You guys have taken it down to that level of saying these builders, they don't do books. That's not their expertise. Their expertise is building and managing subs and, and buying materials at the right price. And, like that, it's a completely different thing. And so by adding that value, it adds value while mitigating and removing risk. And so, generating obviously above average risk adjusted return, of course, is the ultimate objective.
Yeah. And for me, for us, if we source great real estate deals, which I know that we do, and if we have good builders that, really know how to build and, are on top of it. And by getting some of the good builders, you have to have some value to add. And, if you're just a lender out there, they can go anywhere and it doesn't really matter. But, when a builder comes to us, here's what they get. They get a partner that's helping them underwrite a deal. They get somebody who's going to take their project through permitting for them. They get someone who's going to do their books on the deal, and they get a deal acquisition machine that will be funneling them some deals if they need extra deals to look at. And you're just not going to get that out there. So we can demand some of the best builders come to us, even though sometimes they don't like our rates. They go, God, your rates are kind of high, but well, look what we're giving you.
No, that's right. It's a premium. You're delivering a premium. Like it's an ultimate value proposition. I mean, it is. Yeah, there's no doubt.
Yeah. And so that part has been, really, it's done really well. And, again, for our investors love it because they like the fact that, we do everything in this Seattle market that we know. And, I've looked at other funds, and for me, my comfort level is staying in markets that because I know when you get out, and Lance, you and I have talked about this, but when you get out into other markets that you think but you don't really know, a lot of crazy things can happen, right? Yeah. And so, I can tell you right now, if a property comes up anywhere in downtown Seattle in a developable area, we probably already looked at it, first of all. But if one comes up, we're going to know exactly what it is, exactly what you can do with it, and exactly how much it's worth. Because at the end of the day, if you're buying the stuff right and you're building and you're executing on it, there's some money to be made. If you're buying it wrong, it's a no winner right from the start.
Yeah, that's exactly right. I mean, that's what every guest I have on is all in agreement. Like everyone knows that you got to buy right, but it's like you've got to know what the right buy price is, or what I mean, and it is. I mean, real estate. That's the beauty of it. Is it's inefficient, which is what allows you to generate returns. It's fragmented and it's local, right? Yeah. And it's everywhere, right? So it really is. I mean, unlike the public markets or whatever. I mean, one could argue it, but I mean, they're primarily very efficient, right? The price that's there is probably what it's worth. I mean, it's debatable, but the point is that it's difficult to beat the system. It's extremely efficient, and it's hard to generate alpha. Right. And that's why you got to look at markets in things like real estate, which it's inefficient because it's everywhere and no one can know. And it's fluid, right? As you guys know, I mean, areas gentrify and they come and they go and it's cyclical. And that's the beauty of it. But it really is, knowing the market is key. And I think that as a good segue sort of into Seattle in particular, I mean, it's been on. I mean, there's some unique things about Seattle that make it a great place. And I think that obviously with all of the Fortune 500 companies and all those things, obviously the sort of topographical limitations that it forces, where you can only develop so many places, which is a good thing. But maybe you can speak to sort of the economics behind it and sort of this how out of whack the supply and demand is for housing in Seattle.
It is pretty crazy. And again, this is our pocket we're in. So, we hear about other pockets, but, we're very fortunate to be in this one. I mean, the population growth has been always in the top 5 of major cities for the last number of years here growing. But, between Google and Microsoft and Amazon and Costco and Boeing, all these companies that are driving more people here. I mean, Google just keeps buying up more property and they're building, more facilities. And so what a lot of people don't understand is that, we have this huge demand here and our inventory has been very limited and the prices have just keep going up. And every time the prices go up, people say, oh God, now it's going to finally slow down. But the problem is it's not slowing down because there's not any inventory out there. Yeah. And so, we've had, we went through a year and a half ago, we went through a city change where the city came in and they changed all their permitting software in the city of Seattle, and they got a brand new system. And what that did basically is the city didn't know how to work their new system. So everybody that was in for permit got pushed out about 7 to 8 months on their permits because the software that they, incurred they didn't know how to utilize it. And so what that did is it took about a 7 or 8 month period where all new construction was almost came to a complete halt, where you have this window where nothing was coming out, right? And now you have, again, all this buildup again while people were still coming. And so, they've worked with the zoning ordinances and, the densities. There's a lot more density now in Seattle. And, we have the deal here where, you can build in backyards now, which is actually pretty popular in the core of the city.
Right.
Somebody will sell off their backyard for $100,000 and a builder will come in and put a 1,300 square foot home in there in the backyard. And it'll be in an area that you can walk to downtown and everything. And so those are all sorts of, but the problem is it's become so complicated with figuring out what you can and can't do. If you don't have a team like we have, the average builder out there can't figure out what he can do and what he can't do with all the zoning changes. And then because the market has been increasing so much in price, everybody thinks their property is worth a ton of money. So everybody always asks us at Legacy, well, how are you guys finding these deals? Like, you still are coming up with deals because the numbers have gotten so high that it's tough to develop because people are selling these little teardown houses for $1 million too or whatever. Yeah. And so one of the things I'd give you an example, this just happened yesterday. So we most of the deals that we buy are off-market deals that are brought to us by real estate people. A lot of them are the high-end real estate agents that source dirt deals, development deals, that have been tracking these properties for 5-10 years. Right. And they have big lists, and they bring most of their deals to us because they know Legacy can perform on them. And the other thing is, if they find a developable deal, these agents like to bring them to us because they know we can break them down better than they can. We can tell them what can be done. And so we look at, Chris's group we track at about 25 deals a week. We're probably interested in 2 or 3 of the 25 that we see, right? Most of those are not listed deals. But just to give you an example, Lance, yesterday we tied up a deal that is in the core of Seattle, and it was actually a listed property that somebody put up. It's a developable property, and they had listed it, and they had put down, you could put, 3 townhomes on the property. And they already had a breakdown and a map of what you could do in the whole bit. And so, we take a look at those things too. And the reason it was a big piece of property, but they could only get 3 units on it because they had an exceptional tree on the property that was like cutting down, the probably highest and best use of that property. So we've dealt with a lot of exceptional trees here. We have a big tree issue here in Seattle. It's very tough to take trees down and do things like that unless you really know, how to funnel your way through the system. But anyways, we took a look at this property, and there were some things that we could do and maneuver and work around this tree issue that we had and get by the tree issue where you could actually get 5 units on that property. And so we turned around and we made a full price offer on that property and bought it. That thing had sat on the market for about a week and a half, and any builder that would have known you could build 5 units would have bought that thing in a minute. But they just didn't have the knowledge. But again, back to your Seattle market, it's a competitive market. And it is, prices have done, really, really well. I will say that through, we had a little bit of civil unrest through this whole COVID-19 and election period that might have slowed a few things in the core down a little bit.
Sure.
But the Seattle market has been nuts. And the way we see it with inventory as low as it is, it has to still keep climbing. I mean, we watch inventory on a weekly basis.
Yeah. And that's what I mean. And that's like you said, I mean, at the end of the day, though, it's being cognizant so that your turns are fast, right? That's how you mitigate that. And so you obviously have exposure, but the market, let's assume that the market tanks, like something that we don't even know, not a pandemic or whatever. I mean, it's still, it's limited. I mean, and you guys survived, like you said, you made it through the last downturn without too much damage. So I mean, it usually always does come down. It's the same in our portfolio too. I mean, we were all over the Pacific Northwest, and it's just, if you treat every transaction, on its face, and you do the right diligence, and you know what you're getting into, and you check all the boxes, and obviously, and use other sort of, risk mitigation strategies of just knowing what you can and can't do in those things, with a highly fluid market. And that's what's great about residential. I mean, it's obviously a lot of work. There's a lot of moving parts. It's laborious to do it because the unit sizes are smaller. But I mean, ultimately, it's that liquidity that you have that, just think if you buy a 250 unit multifamily and the market turns on you, I mean, like, that's not very liquid, right? Like the financing for that isn't easy to come by. you know, and that's the beauty of sort of the single family market. And then when you do have supply and demand metrics where there's just no inventory, but everyone wants to live there and everyone's moving there, right? You're going to, even if it does turn, like look at San Francisco through this COVID thing, you see some out migration, but it's like when you read the media, it was so bad before that even when they decide to start moving out, it doesn't fix the problem. Right. No. And so you have time to sort of respond and sort of back off the gas pedal, and not get caught. And so, but I mean, and that was sort of then we'll wrap up with this, but I mean, even though there's all these great things about Seattle, and I'm not as familiar with it as you are, but there's been guys through this bull run that have got their ass handed to them. Right. I mean, lenders. So what did those, not to name names or whatever, but I mean, like, what is it that those guys did or weren't doing that was reckless? Like, what was it that, like, what is it? Like, how did they lose money and how did they go backwards in such a bull run where it just, everything was going up and to the right?
Yeah. So it's a great question. The one thing I would relate to is, and I'll jump right into that, but, let's go back in that 07, 08 market when, we had the biggest downturn in this market, across the country that, had been in 50 years. And so, but in the Seattle market, we dropped in 1 year, probably about 12% is what we dropped. Now we were doing at that time, we'd kind of ventured out. We were doing a little bit of lending in Arizona at that time because we had some other offices down there. And so we had weren't doing a lot, but we were kind of testing the market. So the few deals that we had down there, we had deals that dropped by 25% down there.
Yeah.
I mean, double what they dropped in the Seattle market, right? So it's a lot easier when you're in this market to kind of mitigate that risk when you're dropping 12% as opposed to 25%. And of course, this market we know really well. We have builders here. We have resources here. So I think that's a big part. But our competition that was out there, and this is what happens in this space that you got to be careful about. You get people that open up private lending companies, hard money lending companies. They're going to lend to builders, developers. Let's face it, construction lending is risky. If you don't know what you're doing, there's a lot of ways to get in trouble really quickly because a lot of them don't have the expertise. But what they did is they went out and they got this great idea. We're going to, open a private lending fund. We're going to raise a bunch of money and we're going to pay our investors 12% or 14% or whatever they say, right? And they raise a bunch of money. And now they got this money and they got to deploy the money. And now they need deals, right? And so this is the big difference between us and them. Ever since day one, because remember, we're growing these big banks and mortgage entities. At one point, I had 350 sales guys. I had mortgage guys that would refer deals to us that didn't fit in conventional lending. So we have this deal flow that comes into Legacy between the real estate community and the banking and the mortgage guys that all know us because we've been here for 30 years. So ever since, Lance, we opened, we have had more deals than we've had money.
Right.
So we passed down deals that we would probably do because of the lack of funds sometimes, but that's how we ran it. All these other guys, they had more money than deals. In fact, they'd be calling us for our turndowns to try to put, deals on their thing. And when you start reaching for deals, and if you're in a good market and the market takes off, you'll probably be okay. But if you reach for deals to fill the portfolio and the market shifts, all of a sudden you have a tough time. But in that down market, when we took a 12% hit, our loan portfolio, if you look at it, even today, it runs at about 67% loan to value. So if we take a 12% hit, nobody's losing any money.
Yeah.
Okay. Now there might be some builders, there might be some projects that take some hits, but our investors aren't losing money. And when you are lending 80%, like some of these guys do, and you're reaching for deals, the dynamic changes really quickly.
Yep. Yeah. And that is it. And so they, like you said, it comes down to, you can't overlook the importance of a really strong acquisition pipeline, right? Like in any of this stuff, and that's why I try to tell, sponsors all the time, like, you got to focus on having your way of finding quality deal flow, right? Yep. Because that's like number one. And then your ability to execute is number two. Everything else is, don't worry about that until you solve for 1 and 2. And like, to your point is that, money flows in, it seems great. But then if you're only getting to pick between, 3 different deals or whatever, and then all of a sudden, you set, your own internal, LTV is, you think it's 60, but the V is off by, 25%. Well, that, and then not to mention then that builder's not experienced or whatever. And then he realizes like, dude, I was I mean, like you over advanced me a bunch of money anyway. There's nothing left. I'm just going to throw you the keys. And now you're left with, and you lose money. Like it happens that quickly.
And it happened to a lot of guys, even in this market. As good as this market was, it happened to a handful of them.
Yeah, exactly. And you see it all over the place. And that's where it's like, yeah, it is. I mean, I think that these debt funds are great. It's great. I mean, the diversity of having a whole portfolio of loans that are in first position, that generates, income. I mean, like there's so much to love about it. Obviously, those are our roots as well, as private lenders. And it's wonderful, but it's not all things are created equal. And you really have to go down to that asset level, first and foremost, to really appreciate how did those loans come in? What is how are they underwritten? All those things. And if all of that stuff lines up, then you can kind of pan out and look at the fund level, which will be some stuff that you and I will cover sort of in subsequent episodes here in a month or so. But yeah, I mean, it's good to sort of unpack this because you guys vertically integrated, touch a lot of things, but we can really dig in and sort of look at. It's easy to talk about. Like it's easy to say out loud, like we do this, our platform, and we lend money and to get the return and it's wonderful and everyone's happy. Like great, but it's not that simple.
It's not that simple. And the other thing that people make the big mistake is they think this is a collateral lending thing. I'm lending on my collateral. Like my collateral is good. They're 9/10 of the way there. They're gonna make a loan if they think the collateral sounds good. And our biggest deal isn't collateral. I mean, of course, everybody wants good collateral.
Of course.
Exit strategy is the most important. And do they really have one?
That's exactly right. Yeah. How are you going to get from the collateral to doing what you need to do to get out of the thing?
Yeah.
You can't just leap a canyon and say, yeah, but there's no inventory. So that's our exit. Someone's going to buy it. But it's like, well, no, they won't. Not if you had to put way too much money into it. And it's, whatever, you're upside down, then what are you going to do? Like you're stuck. You're stuck. And now someone's going to have to take the haircut. You got nothing in it. It's not a good situation. So, I definitely knowing what you're doing is like anything in life. I mean, it's not to oversimplify it, but like, experience and competence and those things, in the shocking development, they go a long way, but especially from a passive investor standpoint, you got to know what you're looking for because there's plenty of guys who talk a good game that make it sound like they're, they've got it all figured out, but just understanding the mechanics of these things and what is in these portfolios and, how to kind of assess those things is really important.
And I think where people, Lance, and this is better than anyone, I think where people get fooled is in a good market, anybody can make money, right?
Yeah.
But what you need to do is take a look. If you're, interested in investing in a fund or investing in some of this real estate stuff, look how people performed in the down market, because that will tell you a lot.
Yeah, it does, and the hard part for most is that there's not enough guys often that are left that actually fought in previous wars. Right. And so, which once again, but it is a huge thing. And like I always tell people, it's like ultimately, to the degree that people haven't gone through a full cycle and they haven't experienced, one of the downturns, then the expectation from as a passive investor should be some sort of premium, right, on your risk. And I think that, that's, I mean, it's always nice when you end up being the guy who's lived through multiple cycles, like we have on our side. Ben, we've fought the battles, we've got the scars, we walk with the limp. But for those who don't, it doesn't mean they're all bad. It just means that, you make sure you're compensated for that risk,
Absolutely.
Cool. Well, this is great. And so we'll cut off for today and we'll pick up and jump into some other areas of the business, but I appreciate having you on and we'll be in touch here shortly.
Okay. Thank you, Lance.
All right. Take care.